What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, we're going to talk about a few real estate-related metrics that investors use to help determine whether a deal is profitable or what the returns are. So let's get into it. We're going to start with our first metric, which is return on investment, or ROI. So return on investment is a measure that evaluates the profitability of an investment by comparing the gain or loss or the profit to its initial cost. So it's a straightforward and pretty common metric used to help understand how well an investment's perform. The formula to calculate ROI is your gain or loss, in the event you have a loss, but generally it's your gain from the investment divided by the cost of the investment, how much money you put into it. So that first part, the gain or the net profit, if you will, this is the income generated from the investment after subtracting all the associated costs or expenses. Your cost of the investment is the total amount of money you've invested. That's your purchase price. Any expenses you've incurred to maintain or improve the investment are also added here. So let's look at a quick example and put some numbers to this. Suppose you bought a property for $100,000 and paid another $10,000 for improvements. After a year, you sold that property for $130,000. So we first calculate the net profit. So that's our $130,000 sales price minus the initial cost of $100,000 as well as the $10,000 on improvements. So 130 minus 110. That gives us a profit or a gain of $20,000. So putting that in the ROI formula, we'd have $20,000 net gain or profit divided by the cost of the investment, $110,000. That gives us an 18.2% ROI. So ROI is 18.2%, which means you have a return of 18.2% on your investment. So ROI, it provides an easy way to compare profitability of various investments. Now, there are some shortcomings with ROI. So it doesn't consider the time, so how long an investment's held. So 18.2% ROI in 1 year, very different from an 18.2% ROI if the same investment was held for 5 years. And it doesn't really, it's a bit of a subjective measure. Is 18.2% good? Well, for many people, yes, if that's better than what they're getting elsewhere. But if your typical investment is returning, say, 25%, then 18.2% may not be good. So there's some subjectivity to it. ROI also, it measures the return, but it doesn't factor in any risk associated with the investment. So that's ROI, return on investment. Next, we have our cash on cash return. So cash on cash return, that's a metric that's used to evaluate the profitability of a property based on the actual cash invested, rather than, say, the property's cost or value. It gives a clear picture of the return on the cash you put into the investment, which is particularly useful when you're assessing leveraged properties. That's where you use financing to make the purchase. Now, the basic formula for cash on cash is it's annual pre-tax cash flow divided by total cash invested. So your annual pre-tax cash flow is just basically your cash flow from the property, your income minus all expenses like mortgage payments, property management fees, repairs and maintenance, but before taxes. Then your total cash invested is how much cash you put into the deal. So your down payment, closing costs, any other repairs, improvements, or expenses that you came out of pocket for while you held the property. So, for example, let's say you buy a property for $1 million. You put $200,000 down. There's closing costs of another $25,000. So you have a total cash invested into this of $225,000. Now, let's say this property generates an annual cash flow of $30,000 after all expenses. Your cash on cash return would be the $30,000 cash flow, so left over after all your expenses, divided by $225,000, the amount of cash you put in, and that gives you a cash on cash return of 13.3%. You're earning a little over 13% on the cash put into the property here. Is that good or bad? Again, that kind of comes down to each individual investor, and you want to compare that to other investments and what your returns look like there. So by focusing on the cash invested rather than, say, property value, cash on cash return captures the impact of financing. So when you use more debt, you have less cash in the deal. So more debt's generally going to give you a higher cash on cash return. Other metrics like to consider that, unlike other metrics, cash on cash does not consider things like property appreciation. It really focuses on cash flow. So if cash flow is your investment goal, if that's really what you want to focus on, this is a good metric to track. Now, so cash on cash doesn't factor in things like property appreciation or tax deductions or depreciation. It's really just looking at the cash flow. So some limitations there, but great metric, especially for those that have a cash flow investment mindset. Now, our next metric we're going to look at is net operating income, or NOI. So net operating income, that's the annual income generated by a property after deducting all the operating expenses, but before deducting mortgage payments and income taxes. So those are things that we would not consider operating expenses. They tend to be investor specific, where the operating expenses are property specific. So NOI focuses purely on the property's operational performance. It helps give a clear picture of its income generating potential. So the mortgage payments and income taxes, they're excluded because different investors might have different tax rates or different borrowing ability. For example, if my credit's bad and I can't get a loan for anything under 10%, but your credit's good and you're able to borrow at, say, 5%, then the mortgage payments are going to be wildly different between the two of us. That has nothing to do with the property's potential earning power. So those along with the income taxes are excluded from the calculation. Now the net operating income calculation is gross operating income minus operating expenses, where gross operating income, that includes all income from the property, rent, any other things like parking fees, or maybe income from laundry machines and washers and dryers. All your gross operating income minus the operating expenses, which those are the costs directly related to the property's operations. They include things like property management fees, repairs and maintenance, utilities, property taxes, and insurance. Again, it excludes your mortgage payments and income taxes. Quick example of how this works. Let's say a property generates $150,000 in gross income annually, and the total operating expenses are $60,000 a year. The NOI would be that gross operating income minus operating expenses, so $150,000 minus $60,000, which leaves us $90,000 of net operating income. So our NOI is $90,000 in this case. That represents the income available to cover any financing costs and income taxes, and then a return for the investors. Now, very related and used often in conjunction with NOI is your capitalization rate, or cap rate. This is a percentage that reflects the expected rate of return on an investment property and is based on the NOI, net operating income, relative to the purchase price or market value of the property. So the cap rate provides investors with a way to compare the profitability of different properties and assess the risk of the investment. Cap rate is calculated by taking your net operating income, NOI, which we just talked about, divided by the property value. So the net operating income, we just talked about gross operating income minus operating expenses divided by property value, which is the purchase price or the market value of the property you're looking at. Now, you can actually flip this formula around and determine what the NOI should be based on a property's value or asking price times the cap rate. So if you know the cap rate in the area is X percent and the property is, if they're asking some value or some amount for the property, you can back into what that NOI would be based on the cap rate and the price of the property or whatever you're planning to pay for it. Now, an example of cap rate calculation is, let's say, the $90,000 of NOI from the last example we talked about. And let's say the property has a value of $1 million. That would give us a cap rate of 9%. You take the $90,000 NOI divided by $1 million property value, that's a 9% cap rate. So in this example, we come up with 9%. That indicates an investor can expect to have an annual return of about 9% on this investment, assuming they pay $1 million for it. Now, the relationship between NOI and cap rate help investors make informed decisions on the property acquisition or sale. So and again, you could rearrange this formula. You can also determine the property value based on the NOI and the cap rate. So the property value equals the NOI divided by the cap rate. So in the example we just looked at, say we didn't know the property value, but we knew the net operating income and the cap rate for the area. We had net operating income of $90,000 and we divide that by a 9% cap rate, we get a value of $1 million. So the cap rate also helps assess risk. So a higher cap rate typically it indicates a bit higher risk, but potentially higher returns. Often the higher rates are going to be in areas where properties are a bit lower in demand. Then the inverse is true with lower cap rates. Typically going to see lower risk, steadier returns, and found in areas with high demands. Higher demand pushes the cap rate down, which decreases your return, but it also decreases risk, and vice versa. So the cap rate allows you to compare properties that have different values, NOIs, and risk levels. So you can use the cap rate to determine the price that you're willing to pay for a property, give it on its NOI, and it helps you provide you with what the expected rate of return can be. So to recap, we just covered 4 different real estate metrics. So first we had ROI, return on investment, which is calculated by taking the gain or profit from an investment divided by the cost of that investment. Gives us the profitability of the investment relative to the initial cost. Then we have cash on cash return. This is calculated by taking the pre-tax cash flow divided by the total cash invested in the deal. It gives us a picture of the return on the cash you invested. Then we had net operating income, NOI. That's calculated by taking your gross operating income minus operating expenses, ignoring things like mortgage payments and income taxes because those are investor specific, not specific to the property. So NOI gives us, it's the income generated from operations. And finally, we talked about the cap rate, which is calculated by taking the net operating income divided by property value. This helps investors estimate a potential return from the property. So that about does it for today. I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day.
This audio segment was edited by me, Adam Rothstein. If you would like help editing your podcast or narrating your audiobooks, please email me at adamrothstein29@gmail.com. That's ADAMROTHSTEIN29@gmail.com.
So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.